$2 million in a portfolio generates $80,000 per year. That's the rule everyone cites. Here's what the rule doesn't say. After taxes, after account type, and after one timing decision that most people make by default, that $80,000 can land in your actual pocket as $55,000 or as $110,000. Same portfolio, same balance, same withdrawal rate. The difference is not market performance. It's not investment selection. It's three decisions that most retirement content skips because they're boring, and boring doesn't get watched. So, the question today isn't whether 2 million is enough. The question is, does anyone actually know how to run it? I'm going to show you the 4 variables that determine whether 2 million produces a tight, stressful retirement or a genuinely comfortable one. Real math, a real case study, the tax angle that most finance channels completely skip, and the one decision you make once that permanently affects your retirement income for the rest of your life. But first, a metap. Or I want you to hold for the next 15 minutes. Your $2 million portfolio is a vending machine. You spent decades loading it. Every paycheck, every employer match, every year-end bonus you didn't waste on something you'd regret. The machine is full. You retire. You're standing in front of it. Here's where most people make their first mistake. They assume the hard part was loading it. It wasn't. The hard part is knowing which button to push, in what order, and what to do when the machine jams. A vending machine needs the right outlet. It needs to be stocked in the right sequence. And if you kick it when it jams, which is exactly what panicked investors do during a market crash, you walk away empty. The machine still has all your money locked inside. The machine was always loaded. The question is whether you know how to run it. Let's start with the foundation everyone thinks they already understand. In 1994, financial planner William Bengen published research that changed retirement planning permanently. He analyzed every 30-year market period in the historical record and asked one question. What's the highest annual withdrawal rate that never depleted a portfolio? 4.15%. People round it to 4. That became the rule. 4% of $2 million is $80,000 per year, adjusted for inflation. In every 30-year period Bengen tested, it worked. What nobody mentions, Bengen's data ran through the early 90s. We're in 2026. Morningstar's 2023 Sustainable Withdrawal Rate Study found that for a typical 60-40 portfolio in the current environment, a starting rate of 3.3 to 3.8% produces higher confidence over 30 years. The gap between 4% and 3.5% represents roughly $285,000 in additional required savings to generate the same income with the same safety margin. Not a footnote, a real number. But here's the counterpoint that actually matters more. The 4% rule models fixed annual withdrawals regardless of what the market does. No real human does this. When your portfolio drops 30%, you don't take the cruise. You cook at home. Research consistently shows that even 10 to 15% spending flexibility during down market years dramatically extends portfolio survival far beyond what the rigid model suggests. The rule is a floor, not a ceiling. Most retirees, behaving like actual people rather than spreadsheet functions, do better than it models. There are exactly 4 levers that determine whether 2 million is a tight retirement or a comfortable one. Social Security timing, withdrawal sequence, account mix, and spending flexibility. Spending flexibility is the one people underestimate most. The ability to say, not this year, to trim spending by 10 or 15% during a market downturn is worth more in long-term portfolio survival than almost any defensive financial product a planner will try to sell. It's free. It requires no paperwork, and it's the behavioral habit that makes all the math actually work in real life. Today, all 4 levers, and I'm starting with the one that has the highest guaranteed return per unit of effort. In a few minutes, I'm going to introduce you to a man who did everything right on paper and still ended up with a tighter retirement than he needed. But first, let me show you the guaranteed return in retirement planning that most people treat as an afterthought: Social Security timing. You can claim Social Security as early as 62. Your benefit at 62 is permanently, irreversibly reduced compared to your full retirement age benefit. For most people born after 1960, full retirement age is 67. Claim at 62, roughly 70% of your full benefit. Claim at 67, 100%. Wait until 70, 124%, because benefits grow 8% per year for every year you delay past 67. A guaranteed 8% annual return, backed by the United States government. Show me another instrument in 2026 that offers that. I'll genuinely wait. The break-even calculation, the age at which claiming at 70 beats claiming at 62 in total lifetime income, lands around 80 years old. American men who reach 65 live to approximately 83 on average. Women, approximately 86. For someone in decent health, the math overwhelmingly favors waiting. Here's how this connects directly to a $2 million portfolio. Delay to 70, and your portfolio carries more load during the waiting years. Real. But once the larger check arrives, your required portfolio withdrawal drops sharply. Someone spending $80,000 per year who receives a $26,000 annual Social Security benefit at full retirement age would receive approximately $32,000 at 70. Their portfolio now covers $48,000 annually. At $2 million, that's a 2.4% withdrawal rate. In most historical market environments, a diversified portfolio grows faster than 2.4%. The machine stops depleting. It starts refilling. Claim at 62 instead, and you receive roughly $19,000 per year. Portfolio covers $61,000, 3.05% withdrawal rate. Still workable, but you've locked in a permanently lower income floor, and your portfolio depletes faster every year going forward. Over a 25-year retirement, the compounded difference in portfolio value between optimal and default claiming strategies can exceed $200,000 before counting the lifetime benefit difference itself. If you're married, the higher-earning spouse should almost certainly delay until 70. Not for their own benefit, for the surviving spouse who inherits the higher of the two checks. Delaying the larger benefit is the most efficient spousal income protection in the entire tax code, and most couples make this decision by default rather than design. The Social Security Administration website is, and I say this with something close to resigned affection, a website that appears to have been designed in 2003 and gently preserved as a historical artifact ever since. Log in anyway. Your statement is in there. It shows your projected benefit at 62, 67, and 70. It is worth whatever mild suffering the navigation requires. As for the concern that Social Security won't exist, the trustees project that Trust Fund Res. IRVs could be depleted around 2033 to 2035, after which incoming payroll taxes alone would cover approximately 77 to 79% of scheduled benefits. That is not zero. That is a political crisis too large for Congress to fully absorb without response. Expect adjustments, not elimination. Build your plan with a conservative benefit assumption, not zero. Stay with me because this is where it gets really interesting. Most people think the biggest risk in retirement is the market crashing. It isn't. The biggest risk is the market crashing at the wrong time. This concept is called sequence of returns risk. Here's why the order of returns matters more than the average. Two retirees. Both start with $2 million. Both withdraw $80,000 per year. Both experience identical total market returns over 30 years. Same average, same compounding. The only difference, retiree A gets a severe crash in years 1 through 3, then strong growth for 27 years. Retiree B gets strong growth for 20 years. Then the same C, rash near the end. Same average return, different order. Retiree B is financially comfortable. Retiree A, in many scenarios, runs out of money before 30 years. Because retiree A was selling shares at depressed prices every single month during years 1 through 3 to fund their retirement. Those shares weren't there when prices recovered. The compounding that built $2 million in the first place ran in reverse during the years that mattered most. You don't get those shares back. The damage is permanent. Researcher Michael Kitzes has written extensively on this, and the finding is stark. The first decade of retirement is essentially the only period that determines sequence risk outcomes. Survive the first 10 years with a reasonable portfolio balance intact, and the probability of running out over 30 years drops dramatically regardless of what happens after. The response is almost insultingly simple. Keep 18 to 24 months of actual living expenses not invested, not in bond funds, fully liquid. D in a high-yield savings account or short-term treasury instruments, completely separate from your equity portfolio. When the market drops 40% on month 3 of your retirement, you draw from the cash. You don't touch your investments. You wait. The recovery comes. Your portfolio participates fully in it. Cost of maintaining this buffer, approximately 1 percentage point in foregone returns on that slice per year relative to equities. Cost of not having it, selling your portfolio at its lowest point to pay your bills, permanently impairing the compounding engine that was supposed to sustain the next 30 years. That math is not close. By the way, if this is useful, hit subscribe. The YouTube algorithm won't keep showing you my videos without a direct signal from you. I'm planning to go deep on Roth conversion timing in a future video, and I genuinely hate for you to miss it when it comes out. Now, let me introduce you to someone I'll call Ray. Ray retired at 58 with $2 million, 30 years. Hours of maxing his 401k every single year, employer match every year, dividend reinvestment, never touched it once. He executed the conventional playbook correctly. Almost all of his $2 million sat in a traditional 401k. No Roth, a small taxable brokerage account. No cash buffer. He retired in early 2009. 6 months after the financial crisis had reduced his portfolio from $2 million to approximately $1.2 million. Day 1. Ray was withdrawing 6.5% of $1.2 million every month with nothing else available to draw from. He sold shares at the bottom to pay his expenses. When the market recovered, and it did recover, the S&P 500 tripled from its 2009 lows by 2013. Ray had fewer shares left to participate in that recovery. He kicked the machine when it jammed, not out of emotion, out of necessity. There was no buffer. There was nothing else. By 62, the financial pressure had accumulated enough that he claimed Social Security early. His benefit was permanently reduced by approximately 28% compared to the previous year, paired to waiting until 67. Over a 20-year retirement, that's roughly $55,000 in permanently forfeited income. Not a market loss, a timing decision made under pressure. Ray is fine. He owns his home in Phoenix, but his $2 million retirement is tighter than it needed to be, and the gap traces precisely to 3 decisions: account concentration, no cash buffer, and a default Social Security claim. Not the market, not bad investments, the operator. The machine was loaded, the manual was missing. I'll come back to Ray in a few minutes because his story has a second act that most financial videos would never include. In a few minutes, I'm going to show you a realistic scenario where these 4 levers, pulled correctly, produce a growing portfolio 2 decades into retirement, not a declining one. But first, here's what most people are quietly leaving on the table every single year. Your retirement savings likely live in some combination of 3 account types. The ratio between them matters, as much as the total balance. Tax-deferred accounts, your 401k, your traditional IRA. Money in pre-tax grows tax-deferred comes out as ordinary income in retirement. Every dollar every year, including every dollar of growth. Pull $80,000 from a traditional 401k, and the IRS treats it exactly like a paycheck. After a realistic effective federal tax rate of 17 to 22% for a typical retiree, you net $63,000 to $66,000. That's $14,000 to $17,000 below the headline number. Over 30 years, $420,000 to $510,000 that never reaches your bank account. Not bad investment picks, not high fees. The outlet, your brother-in-law, the one with $17,000 in a token he discovered on a Reddit thread, and very firm opinions about why paying taxes up front is a sucker's game, would like to tell you the traditional 401k is fine. He's not wrong about everything. He's wrong about this. Roth accounts, the Roth IRA, the Roth 401k. After-tax contributions, completely tax-free growth, completely tax-free withdrawals in retirement. Ament, not deferred, free. If you have meaningful Roth balances, you have a control panel for your taxable income in any given year. You can stay in a lower federal bracket. You can harvest long-term capital gains at the 0% federal rate available to single filers below approximately $47,000 in taxable income in 2026. Married filers below roughly $94,000. You can avoid triggering higher Medicare premiums under the IRMA program, which adds hundreds of dollars per month to your Part B and Part D costs above certain income thresholds. This is a real number that real retirees encounter and consistently say nobody warned them about. Taxable brokerage accounts, no contribution tax benefit, but long-term capital gains assets held more than a year are taxed at 0, 15, or 20%. Substantially below ordinary income rates. Strategic withdrawal sequencing from this account can generate meaningful additional after-tax income each year without triggering high-bracket events. The point? $2 million city. NG entirely in a traditional 401k is a fixed, fully taxable income stream. $2 million distributed thoughtfully across all 3 account types is a tax control panel. The machine is the same. The outlet changes everything. There's a strategy called Roth conversion laddering that sophisticated retirees have used for decades, and most people have never heard of. The window between early retirement and required minimum distributions, currently age 73 under current law, is when the play is most powerful. During that window, you deliberately convert chunks of your traditional 401k to Roth each year, paying taxes at today's rate while your taxable income is relatively low. You reduce future required minimum distributions. You shrink future Medicare premium exposure. You build a larger tax-free base for the surviving spouse. It's in the tax code. It's legal. It's boring. It works. Let me show you all 4 levers working together. Caller Sandra, 54, retires at 57 with $2 million, $800,000 one. NA traditional 401k, $800,000 in a Roth IRA built over years of contributions and conversions, and $400,000 in a taxable brokerage account. Home paid off, lives in Raleigh, North Carolina, moderate cost of living, state income tax present but manageable. She targets $75,000 per year in actual spending. From 57 to 67, before Social Security begins, Sandra draws primarily from her taxable brokerage and Roth the First ARA. Her taxable income most years stays below $30,000 federally. She simultaneously converts $30,000 to $40,000 per year from her 401k to Roth, filling the 12% federal bracket without exceeding it. She keeps 20 months of expenses in a high-yield savings account, completely separate from her investment portfolio, untouched. Year 4 of retirement, the market declines significantly. Sandra draws from her cash buffer. She sells nothing. For her, the downturn is a financial non-event. For Ray, an identical market environment in year 1 was a crisis with no exit. At 67, Social Security ends at approximately $24,000 per year. Sandra's required portfolio withdrawal drops to $51,000, a 2.5% rate on her remaining balance. In a typical market environment, a diversified portfolio grows faster than 2.5%. The machine has stopped declining. It's refilling. By her mid-70s in a base case scenario, Sandra's portfolio is larger than when she retired. She spent well. She traveled. She absorbed a market downturn without a single reactive decision. Her lifetime federal tax bill in retirement is a fraction of what Ray's will be. Same starting number, 4 levers, entirely different outcome. Let me tell you what the daily life actually looks like on this income, because retirement content loves to show you the math and skip the kitchen table. If your home is paid off, and I will be direct, this is the single greatest factor in retirement quality of life. Your major monthly expenses in a moderate cost of living area look roughly like this: housing, property taxes, insurance, and maintenance. Ants run $900 to $1,300 per month for most homeowners. A reliable planning rule for maintenance is 1 to 2% of your home's value per year. On a $250,000 home, that's $2,500 to $5,000 annually. Budget it every year as a recurring line item. The furnace does not schedule its failures around your retirement. Food, $600 to $800 per month. Groceries and reasonable dining out. You're retired. Order the wine you want. Healthcare. This is the line item that consistently blindsides early retirees, and I won't soften it. If you retire before 65, you are purchasing private health insurance until Medicare. In 2026, a reasonable individual plan for someone in their late 50s runs $1,200 to $1,700 per month in premiums in most markets. Before deductibles, before dental, because Medicare covers essentially no dental work. Factor in realistic out-of-pocket costs and annual dental expenses, and you're looking at $15,000 to $20,000 per year before anything significant goes wrong medically. AAV. Or budget this line aggressively, then add a buffer on top. Transportation, $400 to $600 per month. Travel and leisure, $600 to $1,000. You spent 30 years loading the machine. Use it for something that actually matters to you. Utilities, subscriptions, miscellaneous, $400 to $500. Total, roughly $4,200 to $5,300 per month. $50,000 to $63,000 per year. On $80,000 in after-tax income, what a well-configured $2 million portfolio actually delivers, you have $17,000 to $30,000 per year in margin. The buffer that absorbs the water heater, the medical surprise, the last-minute flight somewhere important. On $63,000 after taxes from a tax-deferred, heavy, poorly optimized portfolio, you're essentially even in a normal year. Every unexpected expense becomes a stress event rather than an inconvenience. The margin is where retirement actually feels like freedom, or feels like careful, quiet management. The machine is the same. The outlet determines whether you sleep. In a few minutes, I'm going to finish Ray's story. It ends somewhere most people don't see coming. But first, the thing that retirement content almost never says directly. You think the problem with retiring on $2 million is whether the number is big enough. The actual problem is whether you have the psychological infrastructure not to ruin it. The research firm Dalbar has published an annual investor behavior study for decades. The finding is relentlessly consistent. The average equity fund investor earns roughly 3 to 4 percentage points per year, less than the funds they're actually invested in. Same funds, worse returns. Because they buy in after rallies, sell during panics, and buy back in after recoveries. Systematically buying high and selling low while the fund quietly compounds in the background. Apply 3.5 percentage points annually over 30 years to a starting investment of $200,000. At 8%, you reach approximately $2 million. At 4.5% the behavioral tax-adjusted return, you reach approximately $900,000. Same starting amount, same funds. A gap of over $1,100,000 explained entirely by decisions made in moments of fear or greed, not by the market itself. Whilst financial mistakes are not math problems, they are brain problems. The math of a $2 million retirement is genuinely not complicated. Sitting completely still while your portfolio falls 40% in year 2 of retirement and doing absolutely nothing. That is the actual test. That is where retirement plans fail in the real world, not in the spreadsheet. The investors who outperform over 30 years aren't the ones who made superior selections. They're the ones who did less, who read the news and did nothing, who watched the portfolio drop and did nothing, who let the machine run. Inflation gets a paragraph because it's the slow-moving risk people chronically underestimate. 3% annually, historically normal. Roughly the Federal Reserve's long-run target halves purchasing power in approximately 24 years. Ours. $80,000 in 2026 requires approximately $160,000 in purchasing power by 2050 to buy the same things. You need equities in your retirement portfolio. Not 50%, 60 to 70% for someone with a 30-year horizon. The Shift Everything to Bonds advice was built for 15-year retirements. Yours might be 35 years. The machine needs to keep producing. Now, let me finish Ray's story. At 68, Ray teaches financial literacy at a community college. 2 evenings a week, $17,000 per year. He started because someone asked, and he said yes, mostly to fill the Tuesday nights. He didn't expect it to matter. Explaining how 401k tax deferral actually works. How the Roth conversion window is the most underused legal structure in personal finance. How the cash buffer is the single thing separating a retiree from the worst financial decision of their life. Teaching these things to people who have never had anyone teach them that turned out to be the most engaged Ray had felt in years. His social section. Security check covers his basic expenses. The college stipend is discretionary travel twice a year. The grandkids, dinners he actually chooses rather than ones that fit the number. The portfolio has stabilized because he draws almost nothing from it now. His decisions in 2009 and 2011 cost him real money. $100,000 to $150,000 in forfeited Social Security lifetime income. Another $100,000 or so in compounding loss to forced equity sales at the bottom of the financial crisis. Permanent, quantifiable, irreversible losses. His retirement is actually pretty good. The machine was always loaded. He eventually figured out what he actually wanted from it. 3 takeaways. Specific to this exact situation. Nothing generic. 1. Audit your account mix before retirement, not during. If 90% of your retirement savings sits in tax-deferred accounts and you have a decade or more remaining, start directing meaningful contributions toward Roth accounts. The Roth 401k if your plan offers it. The Roth IRA if you are income eligible. If you're within 5 to 7 years of retirement with a heavily lopsided balance, Model A Roth conversion strategy for the window between your retirement date and required minimum distributions at 73. The lifetime after-tax income difference between optimizing this and ignoring it regularly exceeds $150,000 on a $2 million portfolio. That is not a detail. That is a decision worth an afternoon of your time. 2. Build the cash buffer before your last day of work. 18 to 24 months of actual living expenses, fully liquid in a high-yield savings account or short-term treasury instruments. Completely separate from your equity portfolio. This is the structural protection against sequence of returns risk. It requires no market knowledge, no investment expertise, no ability to predict the future. It requires cash and the discipline not to deploy it into something you're excited about. Ray didn't have it. The machine jammed. He had no choice but to kick it. You have the choice. 3. Run your Social Security timing as a deliberate financial model, not a default. Go to ssa.gov. Get your statement. Look at your projected benefit at 62, 67, and 70. Calculate the break-even age against a realistic life expectancy estimate. If you're married, model both spouses' decisions together. The interaction between two claiming decisions is non-obvious, and the stakes are real. Write the decision down. The difference between optimal and default Social Security timing for a married couple regularly exceeds $100,000 in combined lifetime income. It's pure arithmetic. No market forecast required. No financial advisor required. Math. Lazy investing built more fortune than crypto memes. That's not inspiration. That's the SPIVA data and the Dalbar data and a century of compound interest doing exactly what it says on the label. S&P's SP1VA report consistently shows that over 15 and 20-year periods, 80 to 90% of actively managed large-cap funds underperform, or their benchmark index after fees. Most individual traders do worse. The edge was never in the picking. It was in the staying. $2 million is real. It's achievable. It produces a genuinely comfortable retirement for most American households in most American cities when the levers are configured correctly. It is not a yacht. It's the freedom to stop performing productivity for a paycheck, to own your mornings, to say yes and no based on what you actually want rather than what your calendar requires. Don't kick the machine when it jams.